Good afternoon, everyone. Wilson Chow is my name. On behalf of the Taxation Law Research Program at Hong Kong U Law, I would like to extend a warm welcome to each and every one of you joining us today, whether from Hong Kong or anywhere else in the world. It's a privilege to have you all with us for this important and timely webinar. The subject of today's discourse, International Tax Framework for Investment, Wealth and Philanthropy Hubs, is more than a legal discussion. It's a reflection of how our global community is evolving as capital flows freely and philanthropic efforts expand across the borders. The framework that governs international taxation assumes a crucial role in shaping not only financial flows, but also the principles of equity, transparency, and accountability that underpin effective and sustainable development. This webinar seeks to provide a critical examination of the evolving international tax architecture, including the implication of BEPS initiatives, anti-avoidance measures, tax transparency, the EU rules, and also the global minimum tax under Pillar 2, which I believe many of the audience are familiar with. We'll also consider a broader impact of these developments on jurisdictions that serve as investment and wealth management hubs, including Singapore as well as Hong Kong, where we are today. And we are honored to welcome our distinguished speaker, Professor Dr. Martin Wiss, a renowned scholar and leading voice in international tax law and reform. His research and insights have helped shape the way we think about tax system in the global world and globalized context. He will be joined by his colleague, Dr. Kirsten Sokic. I hope I pronounced so correctly.
Absolutely.
This is more than, we are looking forward to more than just a seminar. It is also a call to every one of us to engage and think and contribute to the future of international taxation system with purpose. And we welcome thoughts from the audience arising from the talk. And during the talk, feel free to post your questions and comments on the Q&A page using the page, and then we'll try to address them as many as possible. And without further ado, let's now begin our journey today. Over to you, Professor.
Yeah, thank you very much, Professor Wilson Chow from HKU, Hong Kong University, and leading the Taxation Law Research Program here at HKU Law. It's a great pleasure and honor again to be here, and our cooperation for such a long time is quite outstanding, I have to say, and thank you so much for the warm welcome, but also for your comments already on the topic. I think that's a very good introduction. Thank you so much, and I'm also happy that Dr. Totkai is with me from the chair of business taxation and the laws of international and Liechtenstein taxation at the University of Liechtenstein. Yeah, it's a pleasure to talk on this international tax framework, as you mentioned, for investment, wealth, and philanthropy hubs. And so it's a kind of three topics or one topic, in the same way. So investment, wealth, philanthropy hubs, and you mentioned Singapore and then Hong Kong from the Asia Pacific perspective, and these are, I think, two very example hubs insofar that I should use the clicker here. It's this way exactly. No, one less this way. I think they're very prominent examples, and I think one can see quite insofar also the development from being an investment trade hub, also an investment hub, and being for a couple of years, decades, on also a wealth hub. and becoming more and more also a philanthropy hub. So also in these two hubs, there's a kind of history and development and so far. And if we talk about the tax framework in so far, going also a little bit into details, you mentioned some BEPS and many other framework topics. At the very end, there is this kind of focus and question on the impact on the future position of these kind of investment, wealth, and philanthropy hubs. And we see, of course, also some of them in Europe, Switzerland, Liechtenstein could be named, Ireland, Luxembourg, but also in the Middle East, a growing number of places in that area. Having said that, let's have a look on what could be regarded as the level playing field on taxation. And if you think this is a little bit crowded, then I would say, yes, it is quite crowded. So we have this kind of who determines what, including G7, G20, OECD, and we have just learned last weekend, maybe we've forgotten it a little bit, how important the G7 and one player within the G7, so the G3 giants, might be in the so-called level playing field on taxation. And we learned again, I would say, that this is a very dynamic process, that it is a global process, but with very distinguished players, to say so, and not only global in a way of this is one standard, one level playing field, or maybe it's one level playing field, but there are many and quite different players on the ground. It is fragmented, not only dynamic, but quite fragmented. To our impression, fragmentation rather continues than it is at the very end, and we just come to kind of global standards, international standards that are of relevance. A very important topic is, of course, globalization, digitalization, and mobility. So it has a lot to do, and there's quite an important link with regard to multinationals, multinational enterprises, to be clear, but also more and more ultra high net worth individuals being a very distinguished group of individuals, and also the respective hubs. Hong Kong and Singapore have just been named, Ireland, Switzerland, Liechtenstein, Luxembourg, the Middle East, Qatar, and the UAE might be named as well. So this is quite interesting, and we are on the way. Let's see how this will continue. That's too early to say something in that respect with regard to the UN Framework Convention. And also we have these multiple challenges by the global South, and this makes this kind of picture so dynamic, but also fragmented on a current stage. Having said that, and this is also something to do when having a closer look on literature and also on scholars who are, let's say, more close with global South topics. And I learned that one can see, let's say, the multinational enterprises world in a way of their headquarters, and there are many operational companies, of course, worldwide in all jurisdictions, to say so, and they are very kind of specific hubs, investment companies, and this is on the right hand side the kind of the investment hubs, to say so. And in this triangle, there is a lot of this kind of a level playing field, and we can have a look around how this level playing field, how these tax framework looks like, and what are decisive factors in so far to be identified. One identification over the last years, and this has been, of course, named very often just to remind it, is the so-called race to the bottom with regard to corporate income taxes, corporate income tax rates, statutory rates, but also regarding tax burdens if we take into consideration the tax base in so far. And this is a kind of a global development. This is a kind of a regional development, and of course we have some quite focused players in so far as we always talk and think about players on this level playing field. And having said race to the bottom, there's also a race to the top in a way. If we have a look on corporate income tax per revenue, and one of the most prominent is Ireland. Next one would be Switzerland, and further below the Netherlands. But quite Ireland is a very interesting example. It has a lot to do with the success story of Ireland that started, of course, quite earlier. But there's also a kind of link regarding taxation, regarding corporate income tax, to name it quite specifically. Of course, there are many other factors, not to forget that. But corporate income taxation is quite an important part. Yeah, having said that, let's have a little bit a deeper look with regard to empirical evidence on that. And with that, I have the pleasure to give over first time to Kasim. Kasim, please give us a little bit more insights in so far.
Thank you. Absolutely. Continuing and staying in line with the development regarding corporate income tax development and the race to the bottom that you just mentioned a bit earlier, there have been particular OECD-related studies to really address where activity takes place and where profits are being booked. And this is a very particular topic because this was, even to some degree, the start of the story of Pillar 2, global minimum tax, to really demonstrate that there is room for all income group countries to profit. And the story continued also through evidence to really point out that large multinational groups, and these are particularly multinationals that report country-by-country data, so the same type of multinationals that fit in the scope of Pillar 2. And it was a particular study to really address where these large multinational groups report their profits and at roughly what estimates they are being taxed. So as you could see in the upper chart, we demonstrate that, or at least the findings of the OECD taxation working paper demonstrates that at least half of the multinational profits are reported in high income jurisdictions. And then of course, if I move to the latest bracket in our chart, the investment hub group, together we have about 69% of profits booked in high income and investment hubs. There is at least 1/3 of the profits booked in upper middle income and a very tiny portion of profits booked in lower middle and low income jurisdictions. So this is just to demonstrate where multinationals report their profits. And then if I have a closer look to the second chart in this slide, we have the grouping of effective tax rates where these profits are being booked. So in a way, what is the particular tax rate that these profits are being taxed at? And as we could really elaborate on the findings, you see another sort of grouping here that we divide between low tax profits, so 0 to 5% or 5 to 15%. And again, we have in mind that low tax with the logic of global minimum tax starts from 15% CIT, corporate income tax rate, at least the effective tax rate of it. And then we have the next bracket, 15 to 25, and then above 25%. As it is pointed out in here, there is a big chunk of profits, more than 21%, that are under-taxed, at least with the logic of Pillar 2. And then the larger portion of profits, 68.9% to be more accurate, are taxed on effective tax rates that vary between 15 and 25%, and roughly 10% of the profits are booked in jurisdictions with an effective tax rate above 25%. Again, this demonstrates, and we have in focus our picture of investment hubs, wealth hubs, philanthropy hubs, high income, low middle income, and the investment hub, again, a picture that there is a room for all types of income groups to attract profits, but also to really follow a particular tax rate. I will move to the next slide, and this follows a very similar method in the grouping side and also in the effective tax rate follow. But this is a more recent study that really looks particularly at low tax profits. Again, low tax profits is the outcome of a declining statutory tax rate and effective tax rate raised to the bottom, particularly because of the use of tax incentives. So this is the method really applied in here. And as we could look at the data, we see that, again, following the same method of dividing income groups or jurisdiction income groups from high income to low income and then adding the investment hub, it is of particular to see that the bigger part of profits are booked in investment hubs, more than 41%. Of course, this is a very interesting finding, going in line with also what we will discuss further on. Again, low tax profit, according to the OECD method applied here, it's when the extensive use of tax incentive reduce the effective tax rate, not necessarily the difference between statutory tax rate and effective tax rate. Going one step further, and this might be a little bit more confusing, we address how low tax profits of large multinational groups are taxed at particular effective tax rate groups. So when we have in mind, again, these types of jurisdictions from high income to low income and investment hubs in between, we see how the variety of effective tax rate group is also demonstrated in the lower part of the chart in this slide. So we see that almost half of the profits are actually booked in low tax multinational groups, and of course the effective tax rate with 5 to 15%. Again, this is just an issue to demonstrate that the effective use of tax rates increases the need, the necessity, or whatever the storyline could be used from OECD for an under-tax payment system, which will be addressed in a moment regarding the use of Pillar 2. And maybe with that, I just give the floor back to you. But this is just to demonstrate that there is a variety of income group jurisdictions and the particular tax treatment that they receive.
Yeah, thank you so much, Kasem, for this further explanation. And just one addition, not to repeat, of course, all, not to repeat anything, just to see also by the last chart overview that about 50% of the low tax profits are reported in jurisdictions that are not low tax. So I think this is an additional message because of course one might estimate that low tax profits are reported in investment hubs, then that they are reported in rather low tax jurisdictions, below 15%, as you mentioned, but also vice versa. Half of the low tax profits, means below 15%, are reported in countries with a tax burden of 15 to 25, so above the low taxation. So it's not such a clear level playing field between low tax jurisdictions and high tax jurisdictions. Obviously, many so-called high tax jurisdictions are also, let's say, on the ground in the playing field with regard to offering a rather low taxation or lower taxation, to say so. Having said that, and we want to raise a little bit the topic from a tax framework perspective, tax architecture perspective, also as you mentioned in your introduction, Wilson. And of course, we have two important topics, and we will not elaborate that in detail. This is the exchange of information perspective, and we are very far way down. I mean, we, the community, with the exchange of information upon request and automatic exchange of information regarding bank financial data and bank account topics and so on for individuals, but also, of course, with regard to country-by-country reporting, public country-by-country reporting. We just learned that the Australian perspective regarding public country-by-country reporting is quite intensive, to say so. But also, of course, these, let's say, project with regard to harmful tax practices, which has started long time ago, and we should not forget to mention insofar also these kind of standards, as they are very, very keen and well regarded and respected in the world of investment hubs, so in the world of doing business, to say so. As we see, there are just some no or low tax jurisdictions in the focus currently, but above that, of course, that will be also relevant with regard to wealth hubs and also with regard to philanthropy hubs, or with regard to the same hubs being investment, wealth, and philanthropy hubs. The same is true with regard to the European Code of Conduct standards, to call them like this, who can end up in listings, and of course we have seen that with regard to Hong Kong, but also with regard to Liechtenstein, or with regard to Switzerland and countries of the Middle East, and many of them, most of them, got rid of that and adapted their national tax laws with regard to international perspectives as a part of this framework of investment hub, of doing business in so far. And maybe quite interesting if we have a little bit more a general view again to say, well, but how is the situation then with regard to investment companies, with regard to operational companies on the one hand side, and of course also with regard to the framework to determine from scratch or as a reform to determine tax laws, corporate income tax laws, to be clear. Then we have a kind of a divided structure, and in a way we see everything that it is, to say so, on stage. We see everything here in that overview. So the pillar number 2, which is not pillar 2, pillar number 2 is the corporate income tax. So this is the basis, in a way. All legal entities are covered, economic activities, of course, so investment hub insofar are covered, and of course the bases are usually profits subject to corporate income tax that are defined in this way, in that way, of course, according to BEPS standards, including transfer pricing rules of OECD and all that, where we go usually so much in detail. And there is also an applicable tax rate, for instance, the 12.5% as we see in Ireland, or in Liechtenstein, or 17% in Singapore, 16.5% in Hong Kong, and so on and so on. 9% nowadays in the UAE. On the left-hand side, we see, let's say, the first pillar, not pillar 1, the first pillar being globe. So kind of similar setup, but exclusively or specifically for multinationals, and in EU and EEA member states also for large-scale domestic groups with turnover above the 750 million, also economic activities. And with a minimum rate at least of 15%, and all what is covered by globe, we just come in a minute to that. So this is a kind of the economic activities, the investment hubs perspective for companies, but also for the legislators around the globe. Then the pillar number 3, we are, let's say, in the kind of in the wealth centers perspective, in the wealth hub perspective. So asset structures, wealth structures, family offices, as they are usually called here in the Asia Pacific region. There might be a kind of a deviation from the ordinary corporate income taxation insofar, offering a lump sum taxation or even a tax exemption or the like. But to a certain extent, more and more, we clearly see that all these kind of vehicles rather share that they are not able to do any kind of extended, to say so, economic activities. So in a way, we clearly follow not only the FHTP, but also the EU Code of Conduct rules, and maybe in addition, not one by one, also a kind of the EU state aid topics in so far. So that can be regarded, let's say, as the wealth hub column, as the wealth hub pillar in so far. And then on the right hand side, and in a way with a very similar focus, so also not doing kind of economic activities, being able to receive a tax exemption, even entire tax exemption, is the part of philanthropic entities, is the part of charitable entities, being tax exempt as let's say the offer of philanthropy hubs, but also being able, these hubs, to exempt them from corporate income taxation, not because of the doing good for society, but because they are not in the economic activities perspective. And I think this is quite important to see, and to see the line between investment hub on the one hand side, and if any further tax benefits, favorable taxation is offered, then this goes hand in hand with, let's say, a kind of a less economic activities, or even the rule out of any economic activities. How is this regarded by our friends from Tax Justice Network, to name it like that? And we are always open for debate, because we think an open debate is always very helpful, and an exchange of views. One can learn a lot, both sides, and we see this kind of well, it's not drawn the picture that's by us, but the ingredients come from Tax Justice Network, to have a look on certain jurisdictions and to score them with regard to 18 indicators, how much they look like a tax haven, to say so. 100 of these haven scores, and 100 altogether is the max score, and we see it with, let's say, the classical tax haven, not levying in any corporate income tax. And the red dots are the investment hubs, as they are defined. And then, of course, we see also countries and jurisdictions like Switzerland, Singapore, Ireland, Hong Kong, the Netherlands, and Luxembourg, to see them that they are also in a way in the window, being investment hubs, being not pure tax havens, not at all. They all join a clear corporate income tax system, quite attractive. And we see UAE, and a very smaller dot here is Liechtenstein, and then UK and other countries, insofar being classified as high income, insofar. What is interesting, besides the x-axis, is of course on the other side to see, well, does global scale weight? So in a way, how important are they? Not only how they are classified, and this can of course be discussed with the colleagues from Tax Justice Network, but also, and this is more objective facts, so the global scale weight, which is just the sum of inward and outward foreign direct investments. And therefore one can see also the link, of course, between jurisdictions where the ultimate beneficial owner is rather within the country, or rather not within the country, but it is channeled through these hubs. And also to mention, and that would be a part of the more detailed discussion, of course, there's also a discussion underway with regard to the positive impact of these investment hubs, especially with regard to investments in lower income countries and jurisdictions. So just to try to give a rather comprehensive picture, and not only the one we would draw from our perspective. You already mentioned Pillar 2, the global minimum taxation, and Kasim, you as well. And this is always our starting example. There is this A parent company. There is no issue with Pillar 2, as the effective tax rate is 25%. There are these B countries. In country B, there's also no issue, although one is low taxed with 5%, as there is this jurisdictional blending in country B, and altogether it's about 15% average effective tax rate. But we have these subsidiary in country C, might be the company in the deemed investment hub, using an IP box regime, or we have a lower tax rate than the 15% insofar. Having said that, the focus is on that, and of course we always have, if we talk on tax framework, tax landscape, tax architecture, we have to take into consideration what we call the benchmark system, as we have to understand that globe is much more than just kind of 15% minimum tax rate. It's a full tax system with tax base, tax rate, and also with the corporate income tax system being a worldwide corporate income tax system, as it is known. Tax base, the covered taxes are taken into consideration. to estimate, to determine whether companies in jurisdictions, and then according to the jurisdictional blending, are taxed high enough, so at or above 15% or below this magic 15%. Just two topics in so far, so not to go into detail as we don't talk on globe in particular. So of course, so-called low tax countries, and Carsten mentioned it, so all below the 15% to have a clear measurement also in so far. There is just room to say so for top-up tax in a way to come to this 15%. And there are other ones, France as an example here, Ireland is the first example, but France as an example, where of course classical tax incentives can still be used in a kind of a blending system. You just remember this is in a way this country B, as we have seen with a little bit different tax rates, but that's an example for this kind of country B, and having France now on the left hand side here. On the left hand side we see, well, there is still kind of BEPS, let's call it BEPS, possible in a way of domestic BEPS blending, but there is no possibility anymore for cross-border BEPS in so far. The focus and with that respect, from a tax framework perspective, we want just to draw the attention in a second is on tax incentives. Currently, I think we can see that globally, the first or maybe we saw three topics on stage with regard to globe. The first one was the system as such, including the rule order. Number two, the introduction, the worldwide introduction with regard to the jurisdiction who introduced globe. There was a clear focus on QDMTT, so domestic minimum top-up taxes, to do this top-up regarding the respective companies in the own jurisdiction. And of course, with the aim to get a Q in front of, so not a DMTT only, but a QDMTT, so to be qualified according to the current qualification mechanism, which will be further developed, and so on and so on. And a part of it is then number three, the tax incentive topics, because it is of course a part of the qualification topic with regard to QDMTT and also the income inclusion rule and beyond. But also, of course, as an to say so isolated or more isolated topic, more specific topic. So, which tax incentives might still be followed to encourage substantive economic development and not to be misunderstood only. There might be this on the market as well, but not to be misunderstood only as a kind of the lower the better. Without any economic perspective. I think that's quite important to mention it as many tax incentives in many countries, and we are here in Asia Pacific, have a very clear dimension and direction to encourage very substantial economic activity and to speed up the process and not to wait only for the market to have these kind of results according to good economic conditions. I think that's fair enough and very important to mention that. Three examples we have here, and start first with the example of Ireland. Ireland was quite active in this process of contributing to the globe system, but also regarding the implementation of globe and having amended its tax incentive policy with the amended qualified refundable tax credit, as it is called, this QRTC, being in line with the globe rules, but of course being still attractive. A second example, and this is in a way work in progress, and very interesting, is the example of Singapore with regard to the refundable investment credit, which is a part of the introduction of the globe rules in Singapore. With regard to 2025, the qualification is still ongoing, as are the detailed legislation and further details to be come out regarding this refundable investment credit. And we just mentioned here two perspectives to say. So one is there will be a kind of a development by OECD, by the inclusive framework with regard to hallmarks or the like criteria to approve qualified tax incentives. And we can already read in the commentary and in the material of the globe rules that the Q status, the qualified status, should not be mixed up, to say so, and jurisdictions should not provide multinationals with tax incentives that are in a way related to globe rules, including the QDMTT insofar. So that's a very interesting part of it. And going back to the overview, there are also Swiss cantons that might have a look on what is going on in Singapore, how these incentives for substantial development are effectively designed, precisely designed. But in Switzerland we see also different cantons. The canton of Zug, for instance, who is let's say combining even how to say, more sophisticated in a way, or deemed sophisticated in a way, tax incentives that are income based, with a QRTC perspective. And that will be quite interesting to see how this will develop. So this is also work in progress, but it should be mentioned here as it is one of the most important, to say so, developments in that perspective. And we see again we are on this level playing field, and this is the framework, and also it's the framework to see, well, there's a global minimum tax of about 15%, but it's not a kind of an end of a story. Neither regarding the tax burden per se. Of course, there can be a higher tax burden. This is regarded as the aim, still, or of course as a minimum level. But also in addition, there's of course room for tax policy to support substantive investments, to support substantive economic development. So that's one part in so far with regard to the investment hubs, and with that I would like to shift and go on to go to the wealth hubs, to say so, and wealth hubs being linked, of course, with individuals on the one hand side, and on the other side with wealth structures, wealth structuring, family office as a topic, governed by certain board members, very often trustees, and accompanied for governance purposes by certain councils. And in the focus, of course, is the kind of family wealth with many topics of asset allocation, asset structuring, and so on and so on. So we have the family, the mobility, the residence topic back on stage, and we just see kind of seminars and scholars who again focus very much on residence, also countries and jurisdictions, and also court decisions who have this more and more in mind, besides further topics we just come around on that, and of course all these topic of wealth structuring. With that, of course, we see a kind of how to say, moving process. I mean, we talked about mobility, and this triggers two topics. One is a favorable tax system for individuals, and the other is these huge kind of migration we see by individuals, but especially also by ultra high net worth individuals. And this is my second task to give again over to Kasim. Please, the floor is again yours.
Yes. So as you pointed it out, we're moving the focus from the tax treatment of legal entities and particularly corporates with the development from Pillar 2 to another type or another group of taxpayers, individuals. The topic that has been very much developed and researched recently is the mobility factor. And the reason why we demonstrate it through this map is that having a variety of tax systems out there, of course, this is an outcome, or it is related to, or it is a factor, one of the factors. Clearly, tax is not everything, but it is one of the factors why individuals, particularly in this case, ultra high net worth individuals, might choose to move elsewhere, to opt for another tax residency because of their tax treatment that they will be receiving there. A short disclaimer, this map is always, the world is a dynamic place and tax systems follow the world as well in that sense. So of course there could be some particular cases where we cannot demonstrate it exactly what the tax system of a country is, but this is just to point out that there is a variety of tax systems out there. As you see in this map, we focus on no or almost no income tax countries, and you see a lot of them in the Middle East. We have territorial tax systems, a lot of those in Asia Pacific and some part in Central America, but also in Europe we have countries that offer some form, quasi, maybe not fully territorial tax systems. We have the topic of a lump sum taxation, particularly in Italy and in Switzerland. We have been discussing a lot, where it's a form of a flat tax that an individual pays to relocate to the country. And then we have the remittance-based taxation and then the inbound taxpayer preferential treatment of income. The scope, again, is that we have a variety of tax systems out there. Within one given country, you could also have a variety of systems, like in Italy that we discussed even last week. You could find 4 different systems for new residents or current residents that relocate elsewhere. Nevertheless, this is part of what we call the benchmark system, the progressive income tax system, and this is where we see how do particular systems fit in this benchmark that we discussed a bit earlier. Going one step further regarding the mobility of individual, we are referring here to the report of Henley and Partners regarding the private wealth migration. These are data for 2025. And as you could see clearly, when we speak about ultra net worth individuals and their mobility, we have 2 types of countries that we can focus on. The countries where they relocate to, so indicated here in blue as the immigration countries, and the countries where they live from, let's say, and that's the emigration type of country. What is the story about in this chart is that we can see a shift in where individuals tend to relocate. Again, as I pointed out, tax is not necessarily one of the factors, but it is part of this factoring system that they choose to relocate. To point it out briefly, you see that we have countries like the UAE, Italy, Switzerland that we discussed also a bit earlier, where millionaires, and we talk in absolute values here, is thousands of them, that they tend to relocate with them. So this is part of the wealth structuring mechanisms, could be family offices, could be other types of vehicles like trust or foundations, but you see the amount of wealth flow that goes to this country. And of course, we have losers, if we may call it like that, like the UK, for example, that we even recently addressed the abolishment of their non-dom regime could be a factor of why particular groups of ultra net worth individuals choose to relocate elsewhere, right? So this is in a way to demonstrate that mobility factor or the tax treatment of individuals is part of this dynamic tax framework that we discussed regarding investment hubs and wealth hubs, particularly in this regard. And then I hand over back to you.
Yeah, thank you very much, Kasim, for these insights. And yeah, this is some evidence as we see here, coming back, let's say, to the model, which try to cover that. then we see exactly with regard to mobility and residencies, these kind of further analysis, what is, let's say, a kind of a real residence, not only a kind of a residence that is addressed formally, and also with regard to residence by investment, and even more citizenship by investments, or quite a deep link between an individual and the country and the jurisdiction. And also insofar, or not also, but insofar, we saw just recently regarding Malta and their citizenship by investment program, a decision of the European Court of Justice that court didn't see or didn't follow, let's say, the Maltese perspective. So the genuine link insofar was not intensive enough, to say so. So the program probably has to be stopped, amended, or at least changed in so far. We see kind of BEPS and Forum Harmful Tax Practice and the criteria of the EU Code of Conduct Group. Of course, there is not, let's say, the full variety as it is with the investment hubs. So all these criteria that have been mentioned insofar are usually not fulfilled by investment hubs these days, as they have amended their tax law. And if we would apply these kind of rules, standards, framework regarding individuals, the main focus would be the non-taxation, the zero taxation argument. Substance might be also a topic, so is a residence linked with substance. In principle, we say, well, if one moves from one country to the other, this has a lot of substance, because you give up one flat, one house, one accommodation, and you build up a new one with everything covered insofar, and everybody who did that and who does that very much knows what we are talking about. So this is not a formality, but of course there are also possibilities to have multiple accommodation, multiple flats, multiple residencies. It's a more formal link, and many other topics insofar. And of course we can also talk about Article 4 in the double tax conventions, and we can talk about Article 29, the principal purpose test. And if we have a look on the commentary, then they are quite kind of also regarding individuals, kind of legal arrangements or the like behavior with regard to building up, changing new residencies in favor of changing a tax system, and maybe primarily because of changing a tax system. So mobility is quite important, and so this is, let's say, the way people behave, the way certain wealth hubs may offer favorable tax treatment, and on the other side, other countries, high tax jurisdictions, very often, of course, have kind of restrictive tax measures in mind regard to the mobility, with regard to transactions, so bringing in, transferring wealth to trusts, for instance, to family offices, and also with regarding the individuals themselves, with regard to exit taxes, and this is in a way provocatively called here lock-in taxes, because they have a kind of a lock-in effect, or might have a lock-in effect insofar. So tax-wise, it's not that easy to change residence, to leave a country in favor of another one. Tax structuring, private wealth structuring, common reporting standard is a global standard. Double tax conventions are kind of a global standard. And also, not to forget, we had that quite some time ago. Also, the application of the global minimum tax might be a topic for wealth structuring. I mean, huge family offices, huge wealth structures might be also in scope regarding the global minimum taxation. And also quite interesting to see assets and to see rather the kind of asset structuring in a way that also tax-wise they are structured relocation friendly. If we think about exit taxes and other anti-mobility taxes. And of course, in the sky, or maybe a little bit further down to earth already, there's this idea of a global minimum wealth tax. So this is not a typo. Maybe you thought first about on the right-hand side on top. So a global minimum wealth tax, and we thought we should name it in a way like that, so that be also, of course, on the agenda, and that it is on the agenda. We see not only with the blueprint presented to the G20 last year, but also that the G20 and the OECD is, let's say, in a way more serious or more linked to all these topics. Yeah. Investment hubs we talked about, wealth hubs we talked about. Let's come to the third dimension of hubs. So let's have a look on philanthropy hubs. And we had the pleasure to attend just recently a conference at HKU with regard to trust, wealth management, but also philanthropy topics. And it was 2 fascinating days being here. So philanthropy is also quite a very interesting topic to be named. And it is also in a way to show first, well, how could it be regarded as a kind of a model, in a way to simplify, but also to see how many topics are on stage in so far. We see, of course, individuals and legal entities that are keen in giving, which is a very positive topic with regard to public benefit purposes on the right-hand side, with regard to traditional but also alternative philanthropic activities, and so on and so on. We also see that there are multiple national and international tax issues in so far. So the giving is one thing. Is it a giving that is supported by taxation? Big question mark. Is the giving supported by taxation if it is a domestic one, or also if it is a cross-border topic? And of course, the receiving, for instance, not only by the public benefit organizations, but also maybe as an intermediate entity, also regarding to charitable foundations and trusts, is of course a topic. Or is it the kind of taxable profits? So receiving is tax-wise not nothing, to be very clear in so far. Next step, and then let's stay for a moment with these charitable foundations and trust. Of course, they can use the received funds to support these public benefit purposes, but also they might use part of it for various investments, classical investments. They receive dividends, interest payments, and so on. But maybe also they think about more, well, can we do not also or enhance not also the impact with these investments? Shouldn't it be only classical investments? And then ESG topics come into play. Impact investment is a part of it, even venture philanthropy. So the finance is not in the first stage, but rather the impact is in the first stage. And of course, this is a topic of charitable foundations and trusts, of philanthropic entities insofar these investments, the returns might be then enhance the possibility to fund public benefit organizations in favor of then the spending for public benefit purposes. Having said that, to show up this model, I give back to Kasem another time with regard to an overview about these tax insights, about these more detailed technical topics insofar.
So as we dive further into understanding the role of philanthropic entities, but also the philanthropic activities, we, as pointed out, we might be prone to many different tax topics. And those are particularly related to the processes that were described a bit earlier, when a person gives and a further entity receives, or when an entity can generate income on their own and then spends it for the purpose that they exist. So not to spend too much time on this chart, but the idea here is that clearly once you go through these steps, depending on the characteristic of the giving and of the donation, different tax possibilities may arise. And it is of very much particular interest when the case is cross-border, because the nature of the donation and the nature of achieving the purpose of a philanthropy entity might have a very different view from that domestic perspective. But first, we might need to have a better understanding of what qualifies as a philanthropic activity. And as you could see, we have done a summary here of what we have in mind regarding investment, wealth, and philanthropy hubs. So we selected a sample of countries, and then we thought, okay, what is their recognized philanthropic purpose, or as defined by the OECD as a worthy purpose? As you may see, particularly when we think of philanthropy, we might have an idea that if one supports welfare, education, healthcare, cultural, civil society topics, and so on, those should qualify as philanthropic purposes. Well, the picture looks like that for most countries, but again, we might have some interesting or maybe less interesting countries where one of these very, very much in the core of philanthropy activity might not be recognized. So the first lesson here is that the purpose that an entity exists, or the purpose that a donation is done, qualifies or matters because that defines also the tax treatment of it. If the charity or if the philanthropic entity will be a charitable or a tax exempt one or not. That is pretty much connected to the purpose that they exist. That's the first issue. The second issue is that we observe that countries around the world, of course, they could follow different types of incentive mechanism that they support such giving and such donations. In this chart, you see most of the jurisdictions opt in for a tax deduction as the preferred way to incentivize, labeled in X here, the corporate donation, and where you see the O or 0 sign, let's say that's when the treatment for individual differs from the one from the legal entities, from the corporation. That is particular in the case of New Zealand, Ireland, and UK, where, for example, let's take the case of New Zealand, individuals are given the right to deduct these donations if they qualify according to their national perspective. But, sorry, the other way around. Corporates can opt in for deduction and individuals can opt in for a credit, let's say. So that would be the preferred mechanism. Again, this shows and points out a few different mechanisms that are out there, but as we have noticed in the report, deductions are the preferred way to incentivize donations. And then a further step that we tend to go is the cross-border treatment of such donations. Of course, we have some particular cases in this world where we have the Union, the European Union, and the internal market, let's say in EU, that tends to qualify the same domestic or foreign, but within the Union, as identical, or to not differentiate between domestic and foreign giving. But that is not the case everywhere. And what we have noticed through the report of OECD, Taxation and Philanthropy, is that about half of the jurisdictions that are part of this survey tend to incentivize also cross-border giving. So what we really thought at first was like, well, it seems to be that governments, tax authorities, whoever is the respective authority, tend to really support through tax mechanisms the domestic charitable entities and also donations, so any philanthropic activity and purpose, but not necessarily that cross-border one. So this was one of the findings to really address that, well, there maybe is a lot of room to improve this view on allowing or not, recognizing as deductible or not foreign givings. This is also quite in line with what I just mentioned earlier. So for time reasons, I'm skipping this, but this is again the public benefit organization and their tax treatment, right? And then maybe we could move into one particular index that they really address the full philanthropic environment in a country, from the tax point of view from the operational side of the philanthropic entities to more socioeconomic perspective and the easiness of operating a cross-border donation or not. Should I proceed with this, or
yeah,
please let's discuss this.
Exactly. Thank you very much, Carsten. Just stay for one moment here. We see in that kind of index on a worldwide basis, almost 100 countries and jurisdictions are included. Of course, not all, and some interesting hubs are still missing in so far, but nevertheless, we see quite one part where environment is quite important, politically, economically, and social, culturally. And on the other hand, the ease to operate philanthropic organizations and tax incentives and cross-border philanthropic flows. And if I just go a little ahead, both tax incentives and cross-border philanthropic flows are linked to tax issues. Having said that, we see here the overall score and according to a scoring model as it is, and on the left-hand side, it's quite interesting to see. Well, this is the overall score of the respective jurisdictions with regard to these six factors. Liechtenstein on the top, just to mention that, not more, not less. With regard to taxation. The picture is a little different. So one of the 6 criteria in so far, but also quite interesting to see, because all these topics are mentioned. Tax deduction is a topic, then the receiving by charitable entities. The objective purpose is, of course, a part of it for tax exemption of the respective entities, and so on. And therefore we also, because it is also a tax link, a fiscal link in so far, we also highlighted here the cross-border philanthropic flows, again with regard to the results for the different jurisdictions. Of course, we highlight the one we have in mind, plus some more of them. And if we have a look on this overview at the very end, then we see quite interestingly, well, how does this kind of position of the different jurisdiction in focus we have, looking at everything, investment, wealth, and philanthropy hubs, how they score in so far. And it's quite interesting to see, of course, the importance of the environment in general, the 3 dimensions, but also with regard to tax incentives, and in addition with regard to cross-border philanthropic flows. Having said that, we would like to close with this, outline, in a way, invitation also to participate regarding a project on investment, wealth, and philanthropy hubs. So as you see, this is work in progress, and this is in a way a kind of a first report and the first discussion on it. And of course, we are very, very happy that so many joined in and will do so also in the future. And this is a kind of a country jurisdiction sample we will have a look at. I think we see evidence that this is quite of interest, that these jurisdictions are in a way in the focus, but in a very diversified focus. So again, as we mentioned it at the beginning, it's not the lower the better. It's a very developed sample of developed jurisdictions, highly developed jurisdictions, rather small countries, and countries with a clear outline, as much as it is possible, with regard to their politics, countries, jurisdictions that have also a particular history. One could go, of course, much further in these topics. And with that, we thank you so much for the audience, and we are even more interested in the Q&A session.
Yes.
Thank you very much indeed.
Thank you, our speakers, for their very insightful talk. Very much food for thought, at least for me. So for the previous hour or so, we have explored very complex and critical dimensions of the international tax framework. is evolving architecture, its implications for investment hubs, philanthropy hubs, and also its role in shaping a future global economy. So we welcome questions from the audience. We are waiting a bit for that because there's so much to digest, and our audience needs time as well, I believe. Let me kick off by asking what I think an interesting question to me. I'm interested most in the migration and mobility of millionaires, and also the wealth, and note the chart, the tables included in the slides, that we have jurisdictions welcoming more millionaires over the year, and also unfortunately some others losing out in this movement. I'm just wondering whether there's any way to track, for example, a millionaire used to be in the UK, where did he go? Is there any way to track that movement, or as a general observation, what may be the observation of speakers who have undergone at least the very first few steps in the research?
Well, thank you very much for this question. This is exactly one we also share in a way, and of course we are not whatever using AI for individual tracking or the like, not at all. And insofar, so I think currently one can only estimate, and I think this is exactly what the report also from Henley is doing, so trying to do so, and of course there are, I think also this morning or evening in the UK, an announcement by a person. He announced himself of changing residence, obviously, to the UAE. So that can be seen. The interesting point, I think, with the UK, if I may put it like this, is that there seem to be, of course, still a variety of topics, but of course taxation is in a way in the forefront, in the window, to say so, and according to these estimations reports we see with Henley, there are kind of migration ways more clearly. So UK seem to feed the UAE. UK seem to feed Italy, in part Switzerland, and then lower from the numbers with regard to other jurisdictions and countries. Right. And maybe also the US is quite interesting because it is high in and out. So that's quite interesting, and the numbers we see here is maybe just more often netting of in and out.
I see.
So, I mean, of particular, there could be certain studies when the non-dom regime was abolished in the UK that many, maybe not academic, let's say, studies, but at least to a certain degree investigative journalism, that they could really point out that there is a flow from London to Milan in Italy. And that was, at least as described, particular to the attractive lump sum taxation in Italy. So particular of a much different treatment from a tax point of view that could be addressed. And it was quite closely linked to the timing of everything happening. Within a few months, you could see this flow. Within the report, I think there is a number of cases that is being described. I see you took some notes also of particular link that you could guess between, is there Chinese individuals leaving to Hong Kong? Could there be a link why we have a number of plus in Hong Kong and a number of minus in China? Of course, there are particular reasons. We chose only the top 6 or 7 in this regard of the charts, let's say. There are countries that are not mentioned in here, but I can recall, for example, Israel was in top 10 of emigration, and one could guess that could be closely linked to geopolitics. Right. You have Russia that could be part of geopolitics. discussions and maybe not necessarily tax. But anyways, this is just to really point towards the diverse treatment that we saw with the next slide of incomes and how individuals tend to make use of these systems and then have this migration and wealth flow, so to say.
Yeah. Oh, very interesting to note about that. The second thing, probably from your comment, which struck me a bit, is that the lower the tax may not be, or not necessarily be, the better. So how would you see, or perhaps how Hong Kong should be positioning itself? Because we all, well, the government at least, always claim that we must keep the low tax rate and simple tax system. With your remark, your comment that I've just quoted, what would you see should be the way forward for Hong Kong, for instance?
Yeah, well, thank you very much for this very honorable question, and I feel very honored. Although I'm how to say, not in the capacity, of course, to give dramatic advice, to say so, to the government of Hong Kong. Let's do it like this. I learned about the tax system of Hong Kong quite a time ago, and was fascinated about the simplicity, as you mentioned, of course, the attractiveness, and also of the, let's call it, territorial, the territorial system, the territorial factor, to name it like that. And I think important is, and this is the problematic issue to just jump in, that of course any kind of tax system is very much, and I go back to this to Globe, for instance, any kind of tax system, but we can also go to the questions of individuals, progressive tax system as we have seen it here, progressive worldwide income tax system. I think very important is that to understand that taxation, the tax system, and historical development are very much or very often in line. And I think two very interesting examples are Hong Kong and Singapore, for instance, and both having a kind of territorial system with or without remittance, and so on. And to see that is therefore interesting, because the territorial system was not designed as a favorable tax regime to attract, in a very global and very mobile world, ultra high net worth individuals. So it is a part of the history, it's a part of the economic development of a very substantial economic development, but not a part of the lower the better, in a way of let's introduce a kind of a territorial system in order to attract many of these raised numbers of obviously mobile ultra high net worth individuals. Having said that, and having seen, of course, the success of the jurisdiction, obviously the decision for this kind of tax system over time and over a long time was not that bad, to be clear. Today, of course, we have international standards that might be respected, and Hong Kong is doing so, and I think this is the way one should do it. So also regarding European Union Code of Conduct requirements, this has for a longer time was not so much on the agenda. In the last couple of years, obviously it came on the agenda with the foreign source income exclusion, to just to name it. The global minimum tax is another part. and of course the all kinds of exchange of information, having tax agreements and so on and so on. So be an active part in this global world, I think is the right way to go forward. But also still, and I admire that in Hong Kong, to think about, let's say, topics that develop the position of the jurisdiction, as we had mentioned at the very beginning, to say, well, at the very end, the question is the impact of the position of these kind of investment wealth and philanthropy hubs, and therefore family offices topics and many others are of course on the agenda. And if I just focus on one, then of course a further development could be to be more open, to be more supportive regarding cross-border philanthropic activities. So not to lock them in too much in a way of should have a very strong link to Hong Kong. We see it also with other respective hubs, but also to lower the requirements so that can also be done and supported cross-border in other jurisdictions and countries.
And thank you very much again for the two speakers and our audience. We look forward to welcoming you to future events hosted by the Taxation Law Research Program at Hong Kong U, and we welcome both of you back in the not too distant future.
Thank you so very much.
Thank you
so much.
Thank you very much, audience. Have a good afternoon.
Thank you.
Thank you, Wilson.
Thank you.